It's almost 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. The dollar and yields rising and Asian stocks trading in a narrow range as investors weigh the impact of another Trump presidency in the wake of his debate with Joe Biden. The PBOC moving to stop China's debt bull market in its tracks by announcing it will borrow government bonds from primary dealers. Also, several global funds tell JP Morgan they plan to buy Indian bonds directly after their addition to the bank's flagship Emerging Markets Index. All right, let's take a look at how global markets are moving at the moment. It's a modestly risk-on tone across the region. For a closer look, let's get over to Avril Hong in Singapore. Avril.
It is slightly risk-on. It's a bit of a mixed bag across the benchmarks in the region and among sectors as well, where you see the financial-related stocks. Those are the ones that are doing well. Overall, we are seeing a picture of higher yields, but infotech, that is the sector that is a bit of a drag on the MSCI Asia Pacific, and investors are also mulling the possibility here of another Trump presidency. Most seem to think that's going to lead to higher yields on the longer end of things. Certainly, we're seeing the dollar climb, as you just mentioned a short while ago. And amid all this, we're seeing dollar yen pop above the 161.6 level. I think this is the highest level since at least 1986. And as all this is happening, it's a bit of a mixed bag when you're looking at Chinese assets. Hong Kong back from holiday today. It is recovering, lost ground about 0.7% stronger. But it's also interesting to see amid the yuan fix that came through, that tweak from the PBOC today, dollar China still edging, nudging higher. And of course, amid all this, it's really about how the bond rally in China late in the session yesterday petered out after the PBOC announced that it would be borrowing some of these government bonds from primary dealers. So we're still watching out for potential selling of securities to cool the bond rally. Of course, at the back of mind is all about how potentially this bond rally has fared. They don't want it to move in just one direction. So this is what we're seeing today, interestingly, the continued climb in Chinese government bonds. Let's take a closer look at this chart. If you flip the board, it's not just how Chinese government bonds are doing well, even as the housing, the stock market, they're both in the doldrums. It is also about how they fared versus some of these other bonds globally. For China, the concerns about the economy, I think, have been pushing investors towards the asset class as a safe haven. But it's a very different picture when you look at the inflation dynamic and what is playing out globally. Paul.
All right, thanks very much, Avril. Let's get a little bit more on markets with our first guest. Also has a bullish call on bonds and alternatives as well. Yoon Eng leads APAC Asset Management Advisory at fintech firm Broadridge Financial Solutions, and she joins us live now from Singapore. Yoon, thanks so much for your time today. Now, you're bullish on bonds, and as Avril just explained there, we've seen a very strong performance for China bonds as well. So what sort of allocation do you have, not just within this bond space, but also with bonds versus equities?
Thank you very much, Paul. So as we're saying, I think one of the biggest things that we're actually seeing from the data outputs from our AI-powered global demand model in terms of forecasting what is going to be the market demand is that we're bullish on bonds. And the reason why is that I think global easing, it's already happening across the board. It might be at different pace, but the market's already pricing into potential rate cuts from the Fed itself. And what is happening is actually putting more cash into the markets, where we actually see more allocations, typically and predominantly into fixed income, into the alt space, and to some extent to selective basis into equities. I think on the bond side itself, we'll likely see sort of the shift towards much more spectrum, especially on the higher risk spectrum. And on the alt side itself, I think we're seeing kind of a really investors pulling back into the private markets, especially in the private credit space.
All right, I just want to briefly interrupt because we are getting some breaking news out of Hong Kong. It is the Saganti case, which we have been following. That case has now been adjourned until October the 15th. So we'll have that insider trading case adjourned without pleas until October the 15th. So we'll bring you a little bit more on the Saganti story in a little while. But let's get back to you, Ning, with your market calls. I mean, we've also seen the PBOC moving to cool the bond market there, borrowing bonds off some primary dealers. It did stall out that rally that we've seen in Chinese bonds, but do you think that that is going to be an enduring impact, or are Chinese bonds just going to resume the march upwards after a pause for breath?
I think from our views itself is that China is actually having to go through some really key structural reforms. I think they sort of all history of having just that fueled economy is unlikely going to have much impacts on the market, especially when the sort of main sentiments or the fears in the market is that there is very weak investors and as well as consumer sentiments going into the marketplace. So there needs to be much more structural changes, and I think China is really sort of trying to improve on multiple fronts itself. We're seeing some upside on the property restructuring. And the sort of regulators are also signaling calls to try to boost China in terms of its pivots to a much more innovation focus, putting more focus on EVs, on AIs, and things like that. So there needs to be a much more structural changes, I think, in terms of what happens before the markets will actually react more positively or more strongly to what the government is actually doing on the bond side.
Yeah, we might get a bit more of a steer on what the government's doing in a couple of weeks because, of course, the third plenum is coming up. That's obviously coming a bit later than we expected, perhaps due to some of China's structural problems. But when that does go ahead, what are you anticipating from policymakers? Because up until now, any stimulus, any support has felt a little bit incremental. Do you expect any change to that? And more broadly, what are you expecting to hear out of the third plenum?
I think the government will continue to try to promote much more stimulus into the markets, trying to boost investors' sentiments, trying to ease up and make bond markets much more liquid, trying to create much more of a monetary stimulus into the space itself. But I think in general, the market is not sort of expecting too much surprises from the third plenum, given that typically, when there's any surprises or when there's a big announcement, typically comes with a leadership changes, but we're unlikely to see that in the upcoming plenum.
I want to pivot now to Japan as well, because we keep getting evidence accumulating that maybe we'll see some tightening from the Bank of Japan towards the end of the month. Of course, yesterday's Tankan was quite encouraging in that regard. What are you expecting when we get to the end of July in terms of tightening?
I think we're expecting BOJ to continue its policy of tightening interest rates. But I think the challenge for the sort of Japanese government is that a lot of what happens with the interest rates, and especially with the weak yen itself, is very closely linked to what the Fed is doing. So there is, I think, definitely interest to actually normalize the interest rates. But at the end of the day, what happens in the market, especially what happens on the FX side, is very much dependent on the sort of things happening in the U.S., which is outside the governor's control.
Of course, Japanese stocks have had a stellar run in the first half. Do you see that continuing in the second half?
I think in general, what we do see is that there is a general negative correlation between the stock markets as well as what's happening in the yen. So I think depending on what the situation is, I think in general, we believe that the Japanese stocks are likely going to continue to trend forward, given the very healthy rates that we're seeing, some of the healthy data we're seeing from the Japanese economy itself. So the likelihood is that the market is pricing in a sort of a favorable, a bit taking a much more cautious approach, depending on how the Japanese markets will be affected by some of the global events as well.
I just want to ask you about your calls on AI as well. How are you getting exposure to the AI boom? Because some of those big names are looking quite pricey now.
Yeah, so from our perspective, what we don't do is really to sort of invest our own money, but what we're seeing sort of from asset managers too, especially from our clients' perspective, is actually seeing them making plans, sort of taking their plans from hype to actually reality and putting it into practice. What we've seen a lot of the players do is to actually implement a lot more use cases of AI, whether it's in the form of data analysis or actually putting into practice. I think a few days ago we saw sort of Bridgewater sort of announcing their launch of a $2 billion fund that's largely powered by machine learning. So that's, I think, it's sort of a big step forward, and we're likely going to see much more advancements in this space. On the Broadridge side, so we've actually launched over 20 AI projects, and the latest one that's just been put out to market 3 months ago was the global demand model, and has already been widely adopted by over 10 asset management companies. So we believe that the interest in AI, the sort of interest in trying to make it as an enabler and also as a way to sort of leapfrog growth itself will continue.
Yoon, just quickly, got a couple of elections coming up that are quite interesting, particularly the one in France, the second round this weekend, and of course in November in the United States. How do you see this reshaping things in Europe and in the US? And are you changing your strategy ahead of these?
Yeah, I think from our perspective, once again, I think the elections call us just almost a continuing trend towards a much more populist vote, because one of the structural and fundamental issue, I think, in the economy is that for the last 10 years or 20 years of growth itself, much of the wealth has actually been accumulated on the top end of the wealth spectrum, and the middle is increasingly squeezed. So in that space itself, we're kind of seeing a lot more reactions as to wanting much more of a protectionistic kind of government, much more nationalist, own country first. We're likely going to see much more local for local practices, and the market is actually pricing in a lot more of a trend and a shift towards much more of a deglobalization. I think those will be some of the big market impacts that will actually have an impact on markets.
All right, Yu Ning of Broadridge Financial Solutions, thanks so much for joining us. Just to recap breaking news from earlier, the Hong Kong insider trading case against Siganti has been adjourned. No pleas have been entered, so that case has been adjourned until October the 15th. This is Hong Kong authorities have commenced criminal proceedings against Siganti. This relates to a block trade back in 2017. Hong Kong authorities suspect insider trading relating to that, but that trial has now adjourned, no pleas entered, and we'll be back at the courthouse on October the 15th. We'll have more on that story in just a moment. Plenty more to come. This is Bloomberg. Well, as we reported, the insider dealing case against hedge fund Siganti Capital Management has been adjourned now until October the 15th. Siganti's founder Simon Sadler and former trader Daniel LaRocca faced a brief court hearing today. China correspondent Min Min Lo joins us now with the details. So, Min Min, fill us in. What happened?
Well, this case has been adjourned, as you heard there, so no trial, no verdict as of now. The defendants are asking for unused materials and evidence related to the case, so we'll be doing this all over again on October 15th, and then a few scenarios could happen. The defendants may be scheduled to enter their pleas. If they plead not guilty, then we will move forward to the trial stage, and there will be a date that will be set for that. So this is a process that could really take many months or even years, and the significant thing about this is that it's held at the district court, which has the highest conviction rate of the different levels of court in Hong Kong, possibly because it's decided only by the judge with no jury. And also the district court can hand out longer sentences of up to 7 years as opposed to the maximum penalty of 3 years that the magistrates court can hand out. But the maximum penalty, though, for insider trading in Hong Kong is 10 years.
All right, so give us some of the background details to this case. What are Sadler and LaRocca accused of, and just how much attention is this getting in Hong Kong?
Yeah, they're accused of insider trading related to a block trade of a fashion retailer, Esprit, back in 2017. Now, the block trade was carried out by another firm called Lone Pine Capital, but the defendants are accused of getting an insider tip from Tony Sorianos, who at the time was working for Bank of America's Merrill Lynch, and Sagenti had then sold over 1.5 million shares of Esprit that they owned, as well as short sold another 130,000 over shares of Esprit ahead of that block trade. So overall, that is over $1.1 million worth of shares that they sold. And our Bloomberg terminal data also showed unusual price movements of Esprit shares around that block trade. It had dropped by 3% per day in the couple of days before the trade and plummeted 13% on the day of the trade. And this is really garnering a lot of attention because Sagenti is really one of the oldest and largest hedge funds in Asia. The founder, Simon Sadler, has built up a reputation for himself as a block trade king of Asia. They have, had very strong returns over the past 16 years, annualized returns of about 12% a year on average. So this really puts an end to a very successful 16-year run of his company.
You mentioned earlier that the court has a fairly high conviction rate. So with that in mind, what are the broader implications of this for the rest of the banking and financial industry?
Yeah, certainly if the SFC wins this case, it would really bolster their reputation as a very strong and effective enforcer of rules in the financial industry in Hong Kong. But the SFC also have to tread quite carefully here because they've been trying to strengthen the rules when it comes to block trading. They've been proposing that the market sounding conversations that banks have with potential clients be held on the record. Now, market sounding is really a stage where banks have conversations with potential clients when they're trying to offload huge blocks of shares, but in these conversations, they cannot reveal the specifics of the trades involved because that contains market-moving information, and this is where the potential of information leakage can occur. But sometimes it's possible to make educated guesses about these potential trades depending on the timing of those conversations because many newly listed companies sometimes have a typical lockup period of 6 months that prevents key shareholders from offloading huge blocks of shares, and banks do keep track of the expiry dates of these lockup periods. And the SFC has faced some pushback from industry players about the strengthening of these rules. They argue that the stronger rules could maybe make Hong Kong lose its competitive advantage against other countries when it comes to cross-border trading. Paul?
All right, China correspondent Min Min Lo there on the Sagenti story. Well, Chinese EV giant BYD, meanwhile, sold a record number of electric and hybrid cars in the second quarter, boosted by discounts and new technology. For more, let's bring in the Asia transport reporter Danny Lee. So, Danny, how good were these numbers for BYD, and what does it mean for other players in the industry?
Yeah, BYD sold just shy of 1 million vehicles for the quarter, a new all-time high, and that was boosted by a record number also being sold in the month of June. So they have strong momentum, but that momentum is clearly being driven by price cuts that they want to try and consolidate its market share. And generally what we are seeing is a top 10 sellers of electric vehicles in the China market, the world's biggest EV market, are consolidating their strength against a whole slew of smaller players. So it is a good sign for someone like BYD. But when we see some of the other rivals, the likes of Geely Automotive Holdings, they also managed to have a good month, and what they've been able to do is upgrade their guidance for annual sales by 5% to 2 million. So they see good momentum, and we have seen that they've been selling pretty well over the last several months. So it's not just BYD, it's other big players and the rest of the industry who are also benefiting from higher sales.
Yeah, of course, another big player, Tesla. Are BYD's numbers good enough to best Tesla as the top EV seller again?
We're around 14,000 sales short of potentially BYD overtaking Tesla to become the world's biggest EV seller once again in the quarter. But even as we speak, having seen Tesla's projections for sales, analysts have cut back their forecast for how many units Tesla will sell. So that gap is becoming ever smaller. And so we're getting close to potentially it could happen. And Tesla has a lot more downward momentum on them. So it's more of a negative quarter for them, as we can see with this backdrop.
All right, Asia Transport reporter Danny Lee there. Let's get to the top geopolitical stories that we're following. The US Supreme Court has ruled that former President Donald Trump has some immunity from criminal charges over his alleged efforts to overturn the 2020 election results. The justices ruled for the first time that former presidents are shielded from prosecution for some official acts while in office. The move has dealt a near-fatal blow to the push by prosecutors to go to trial before the November election.
No one is above the law, not even the President of the United States. With today's Supreme Court decision on presidential immunity, that fundamentally changed. For all practical purposes, today's decision almost certainly means that there are virtually no limits on what a president can do.
Bloomberg has learned that the Democratic National Committee is considering formally nominating President Biden as early as mid-July. Sources say a potential date for the nomination is July 21, when the Democratic Convention's Credentials Committee meets virtually. The DNC says the plan is not a response to the fallout from Biden's poor debate performance. All right, a lot of focus on treasuries at the moment. Let's check how US treasuries are doing. Of course, rising yields have put some pressure on local currencies here, but we see the yields just pulling back a little now. Yield on the 10-year there, 44.74. Worth noting as well that yield curve still inverted. We might see yields move again towards the end of the week when we get those US jobs numbers. Of course, the factory gate data was pretty good, and that's helping to move yields as well. Okay, let's take a look at China yields as well. The 10-year finding a little bit of support after rallying. The government saying it's borrowing bonds to stop that rally from going too far. This is Bloomberg. All right, welcome back. China markets just heading out to lunch. Let's take a look at how markets are doing at the moment. Kind of flat. It's the answer to that question. The CSI 300 off by just a few points at the moment. It's a similar story for the Shanghai Composite, just in positive territory by a single point right now. Yuan weakness, that's pretty much part of the furniture now, 727.12 at the moment against the greenback. We've been talking a lot about bonds in China as well. Of course, we saw a record rally yesterday. People's Bank of China, meanwhile, saying it's going to borrow government bonds from primary dealers, mainly to steady the operation of the bond market, as said in a statement. So that decision made after careful observation and evaluation of the current market situation. So that action that we saw from the PBOC really did manage to put a ceiling on that rally. All right, with a closer look at markets, let's get back to Avril in Singapore. Avril, what are you watching?
Yeah, we're seeing that theme emerging about the possibility of another Trump presidency, and I think traders are bracing for what this would mean for fiscal spending. So on the longer end of things, it's a story of higher yields. That's prompting that dollar strength, among other things, that are fueling the greenback climb. We are also expecting those domestic factors in Japan that's playing out across assets. The Tankan survey just a day ago, of course, feeding into the narrative that the BOJ can hike rates sooner rather than later, that it can, give more details on the reduction of bond purchases. So bonds, we're seeing that continued selling, also tracking what we're seeing in U.S. treasuries. But given the higher yields in Japan, that's also helping to prop up some of the financial related stocks. Those are the numbers that are actually helping the sector, I should say, that's actually helping Japanese stock benchmarks with that green that you're seeing, although it is a bit flat as we're coming back from the lunch break. Dollar yen continues to push higher, way past the 161.6 level now. And let's flip the board and take a look at what we're seeing in Korea as well, because it's an interesting picture that's emerging across assets. Today, we got some of the data out of CPI numbers, and it showed that inflation continued cooling. If you take a look at bonds, that's providing a bit of a tailwind. But again, the idea that the spreads are in favor of the U.S. might mean that any gain we see in Korea bonds, that would be short-lived. The Korean won is the worst performing currency in the Asia Pacific today. And on the stock benchmarks, even though we're seeing the financial stocks doing well, this is in line with what we're seeing in Japan as well for slightly different reasons, right? This is with regard to what we're seeing on the Value Up initiative. The stocks that are coming under pressure today are the likes of Hyundai and Kia, because we got some of the data from U.S. sales, and that show that concern coming through weak U.S. sales numbers. That's for the board again. Take a closer look at what we're seeing in South Korea's CPI print, because it was not just that it showed a cooling continually, but also how on the on-month figure it turned negative. On the on-year, it missed the mark from even the lowest of the economist's expectations. So it looks like there's a likelihood that we could see those rate cuts from the BOK come August, barring, of course, any change in signals from the Federal Reserve that could raise risk on the Korean won, Paul.
All right, thanks very much, Avril. Well, the spotlight on Asia's major currencies, including the yen and the yuan, shining all the brighter as US yields continue to rise. For more on this, let's bring in Bloomberg MLife strategist Mark Cranfield. Mark, the 10-year yield taking a little bit of a breather today in Tokyo, but what sort of pressure is this yield grinding higher putting on Asian FX?
A lot, and it's been that way for some time, and if anything, it's got fresh momentum because of now you can see the traders are seeing the betting market, which has now gone in favour of Donald Trump to win the next presidential election. So since there was a big change in that factor in the last few days, you're seeing people pull on more of these steepening trades in the US market, which is also seen as being a dollar bullish trade as well. So it's kind of a knee-jerk reaction to what we saw in 2016. One of the quick things that happened as soon as Donald Trump won that election was that the yield curve steepened quickly. It helped the US dollar, and the US equities also did pretty well also. So people are expecting something like that to happen again. What's making it easier from a trader's point of view is that you've had this curve inversion in treasuries for a long time. It's been there for well over a year, and that makes a steepening trade from this point of view even easier to enact, because already the longer term yields are slightly below the 2-year yield. So for that to flip back the other way is an easier trade to do, and so people are obviously going to run with that for some time, particularly when they see that the Federal Reserve is signalling if there's going to be any rate cuts, it's quite a way off. It may only come in the fourth quarter of the year, so that emboldens them to go for trades which may benefit from an uptick in inflation and from the fact that fiscal discipline may not be there later in the year as well. So you put all those things together, you've got a steepening in the curve, is feeding into a stronger US dollar, and there's nothing really in the short term that is going to turn that around.
And also in the short term, just a few days now, we're going to get the latest US jobs data. What are the chances here of an upside surprise, and what are the implications of that if we get it?
It's probably been one of the biggest and continuous surprises to traders in the market over the past couple of years, is that the US jobs market just keeps on posting very, very good numbers. One or two blips. But if you think that we're such a long way from the injections of big stimulus for the pandemic, a lot of people were expecting the economy to slow down dramatically already. People thought there may be a recession even by the beginning of this year or end of last year. That clearly isn't happening. And at the heart of it is a very, very robust US economy. Keeps on printing very solid numbers. The unemployment rate is still extremely low by historical standards. So that's helping to keep core inflation high, and bond traders especially can see that. That's why they're not being too aggressive in looking for lower yields at the moment. It's helping the US dollar and US equities especially. It's really underpinning confidence in the US equity market. So we may get some fluctuations around the job numbers, but the fact that the unemployment rate itself is still very, very low feeds into the Fed story and makes it much more difficult for them to come with an early interest rate cut. That's unlikely to change whatever happens with this week's numbers.
Okay, we've also got still a very weak yen here, 161.67. Are we anticipating any intervention?
I mean, certainly it's there. We're in the zone where intervention is possible. But if you think what happened with the most recent bout, it wasn't very successful by historical standards. A record amount of yen was bought by the Japanese authorities, and yet here we are. Dollar yen is actually higher than it was where they started that intervention the last time round. So obviously not a great impact. And of course there's reasons. They can't do much about the US side of the equation. There's nothing the Bank of Japan, Japanese authorities can do to change US interest rate policy. They can only look at what they're doing at home. And for now, the Bank of Japan has been pretty slow to change interest rates. Only one hike, only 10 basis points. That's not very impressive from a market's point of view. They don't seem to have a lot of urgency to get rates up to anything near where it would take away the negative real weight factor. That still weighs on the yen a lot. Negative real weights are a very big factor in weighing down the yen against all currencies, not just against the US dollar. So until that changes, until the Bank of Japan is more aggressive on tightening and they're on the same page as the Ministry of Finance in terms of supporting the yen, it's going to be pretty hard for investors to start buying the yen aggressively.
All right, MLive strategist Mark Cranfield there. Still to come, hear why S&R Associates expects Indian infrastructure assets to remain attractive for global funds. More on their outlook next. This is Bloomberg. All right, welcome back to Bloomberg Markets Asia. You are watching the India Focus, and here's a look at Indian markets just ahead of the open, which is happening in, about 6 minutes' time. And Indian markets regulator SEBI, the Security and Exchange Board of India, is being accused by Hindenburg Research of failing to address the fraud it alleged in a short-selling report on the Adani Group early last year. Conglomerates reporter PR Sanjay joins us now from Mumbai. So, Sanjay, what is Hindenburg accusing the Securities and Exchange Board of?
Very serious allegations, Paul. Hindenburg researchers clearly called out Indian market regulator SEBI for failing to address the fraud it alleged in a short-selling report on Adani Group early last year. And it says it received a shock-cause notice from the Indian regulator in June, late June. And the shock-cause notice noted its report on Adani Group contains certain misrepresentations and inaccurate statements meant to mislead the investors. This report was posted on its website on Monday. And it also said SEBI seems to be more interested in pursuing those who expose such practices, while its investigation into Adani Group has hit a wall. It's very serious allegation, and it came sharply to say SEBI has neglected its responsibility, seemingly doing more to protect their perpetrating fraud than to protect the investors. And we tried to contact SEBI representatives and Adani representatives. They were not immediately available for a comment, but these allegations are coming at a time when India's main opposition leader Rahul Gandhi criticizing Prime Minister Narendra Modi for indulging chronic capitalism and favoring billionaires like Gautam Adani and Mukesh Ambani over the rest of citizens in a fiery standoff between two rivals in the parliament yesterday.
So what's SEBI investigating Adani Group for, and where are we at in terms of the investigation?
So Supreme Court, India's top court, has actually given a kind of a clean chit for the conglomerate. And what we have seen is like SEBI's investigation, the Indian capital markets regulators' investigation hit a clean wall. And Hindenburg is saying that it has made $4.1 million in gross revenue through these shorts. And they are saying that they haven't made money, but they're trying to upkeep kind of a freedom. And they said in clear note, they said with the rise in the killing of or jailing of journalists in India and plummeting of press freedom scores in the country, Hindenburg anticipated that apparatus of the Indian government may, they're trying to, instead of saving investors' freedom, they are hand in glove with these perpetrators. That's what Hindenburg is making serious allegations, and it has called out few banks' names also. So we are waiting and watching how market will be reacting to it, and today what will be, the uproar in the Indian Parliament sessions as well.
All right, Bloomberg's PR Sanjay there. Well, more global funds are said to be ready to register to buy Indian bonds once their weighting in the JP Morgan EM index rises to 5%. Now, this is according to sources familiar with conversations between the bank and overseas investors. For more on this, let's bring in our Forex and rates reporter Subhadeep Sarkar in Mumbai. So, Subhadeep, what are the key takeaways from JP Morgan's calls with clients?
JP Morgan held a call yesterday with its clients, including those who track the emerging market bond index to which India got added on Friday. The sense and the key takeaways from the call is that most funds are kind of have a mix of presence to Indian assets in terms of either onshore presence via the licensing route or through offshore derivative instruments like your supranational bonds or derivative swaps like total return swaps. What seems to be the takeaway is that as the index inclusion increases, India's weight in the index increases gradually 1% every month. So by the time they'll reach 4 to 5%, the expectation is that most of the foreign funds will be taking the onshore route and directly buying bonds in India.
Well, we're a few days into the bond inclusion. How's it progressing so far? What sort of inflows have we seen?
So for the whole of June, we have seen roughly about 2 billion coming into the fully accessible route bonds, which were carved out specifically for foreign investors. And though the market was expecting a bit of bump up in the last 2 days, going into the inclusion with some expectations upwards of $1 billion of flows, but clearly the last 2 days number were a bit underwhelming in terms of about 350 million odd spread over 2 days. So clearly that seems to suggest that investors had already taken their India positions in the run-up to the index inclusion on Friday.
All right, Forex and rates reporter Subhadeep Sarkar in Mumbai. Well, according to Ernst & Young, India's infrastructure sector is poised for strong growth with investments worth over $1 trillion planned by 2025. The government's ambitious infrastructure program requires injections of capital into energy, roads and railways. And our next guest has more than 15 years of experience advising Indian and overseas companies on mergers and acquisitions. So let's bring in Sudeep Mahapatra, senior partner at law firm S&R Associates. Sudeep, thanks so much for joining us. I just wonder if you can give us a sense of just how much infrastructure investment is coming in from global investors, global pension funds, insurance companies, and sovereign funds as well.
So, Paul, I think we've seen a continued interest in Indian infrastructure. Initially, the interest was from Singaporean, Middle Eastern, and Canadian funds, but I think increasingly we are seeing other countries also sort of participate in the Indian infrastructure story. Like you said, the government is planning to invest about $1.72 trillion in the next 4 to 5 years in infrastructure. A lot of the assets that the government creates will eventually get offloaded to international investors. That's the plan.
What are the main factors driving infrastructure investment in India at the moment?
So one, there is a steady supply of assets which the government is creating. The biggest two sectors being roads and renewable energy. Second is that these assets, by now, the international investors clearly understand the returns, the risks associated with it. India has also done a good job of creating stable structures like InvITs, which are like business trusts, which can be used to hold these assets. And finally, I think you can get really good quality local management team to sort of operate and manage the assets. So the combination of those 3-4 factors has sort of led to this boom in infrastructure investments in India over the last 6-7 years. And we expect that trend to continue pretty much throughout this decade.
What's changed for investors interested in putting money to work in India? Is there still a lot of red tape? What more reforms need to be put in place in your view?
The more I talk to international investors, the increasing sense is that they would prefer stability instead of change. So a lot of the regulations by now, people have sort of figured out, what they are and how to sort of structure investments around it. So generally, global funds would prefer the government not to do actually significant changes and I'm talking about the infrastructure sector. There are other sectors where reforms are needed, but I think in infrastructure sector, especially with products like InvITs, the general sort of sentiment has been that SEBI and should not be making too many changes and ensuring sort of stability in the regime. A lot of the people who are putting in money are long-term investors, and they're not big fans of regulations changing every few years. So regulatory stability is actually a bigger sort of concern right now than more reforms, at least as far as the infrastructure sector is concerned.
Okay, so your investors are telling you that they're comfortable with the regulatory framework, don't want too much change. What sort of questions are they asking you about investing in India?
I think the biggest sort of concern still remains around courts and litigation. So once you get into sort of disputes in India, the court process takes a fairly long time, and that's one area I think where India can still do some more work. On the regulatory side, I think the rules of the road have been fairly clear for almost 6-7 years, and in terms of the politics of it, the government has been around for a while, and even if the government changes, we don't expect that the regulatory environment will dramatically change. So on the regulatory side, people are comfortable. I think the one demand that investors still have is India needs to improve its court system.
We haven't really seen investments in renewables pick up very much over the past 3 years. Can you explain the lag there and whether or not you see that changing?
I think it will. But I think a lot of there was some in terms of just the tariff and the pricing. It's quite competitive, and therefore, to that some extent, the overall assets perhaps were not as attractive. But I think in the longer term, India is deeply committed to sort of transitioning to green energy. We are also investing heavily in green hydrogen. So I think in order to sort of achieve those goals, you need foreign capital. So and more assets will be coming on stream from both government and sort of private players. So you would expect that renewable energy as a subsector would probably pick up in the next couple of years again.
One area that funds don't seem to be terribly interested in is acquiring assets through the insolvency process. Why do you think that is?
Again, it goes back, Paul, to the courts, right? Because if an insolvency transaction takes more than a year and a half. And unlike other transactions, you do not have the usual sort of deal protections around that. If something goes wrong with the assets, you can walk away with the deal. You're pretty much committed to the asset once you've submitted a bid and your bid has been accepted. So for a fund to sort of be stuck with a open bid for about a year and a half doesn't make commercial sense. Which is why we haven't seen too many sort of global funds chase assets through the insolvency process in India. It's more of a strategic player. Strategic players are happy to sort of, if there's an asset which makes sense, they're happy to sort of commit, for 1.5 years and hopefully are able to close the deal. But from a fund, given its life cycle dynamics, keeping a bid open for a year and a half doesn't make a lot of sense.
All right, Sudeep Mahapatra of S&R Associates, thanks so much for joining us. Let's check in now on how Indian markets are doing. Appears to be a modestly risk-on tone at the moment. We've got the Sensex there better by about 0.2%. Nifty Bank Index, though, kind of flat at the moment. And the rupee, well, it's weakening a little, still hovering around those historic lows. Plenty more to come. This is Bloomberg. Let's get to some top corporate stories that we're following. Paramount shares jumping in extended trading after a New York Times report that billionaire Barry Diller is exploring a takeover bid. Diller's digital media conglomerate IAC has reportedly signed non-disclosure agreements with Paramount's controlling shareholder, National Amusements. Diller's interest comes after Skydance's takeover bid fell through. Bloomberg has learned that Bridgewater Associates is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading on Monday with capital from more than half a dozen clients. We're told the hedge fund giant is leaning on its own technology, but the new fund will also broaden to include other models from OpenAI, Anthropic and Perplexity. Northern Data is said to be considering a US IPO of its combined AI cloud computing and data center businesses. The potential listing could fetch a valuation of as much as $16 billion and is targeting a debut on the Nasdaq as early as next year. Sources say Northern Data may also sell a minority stake in the unit to investors ahead of the listing. All right, let's take a look at markets at the moment. I want to take a look at Hong Kong in particular. The Hang Seng was closing in on correction territory. Well, forget about that. Coming back from the public holiday, seeing a bit of a rebound in stocks in Hong Kong. Hang Seng better by 0.5% at the moment. A little bit later on, we're going to get retail sales numbers out of Hong Kong for the month of May. China A shares also rallying there, better by about 0.9%. Even the property index performing strongly at the moment. Take a look at Korea, meanwhile. The Kospi having an off day, off by 0.8%. Not the case, though, for Korean banks. Stocks rallying there on media reports that the nation may still announce tax incentives to encourage listed companies.